Okay, good afternoon, ladies and gentlemen. I hope you all enjoyed your lunch and enjoyed this morning's proceedings before that. With this panel, the third panel of the day is a little bit of a kind of continuation of the last one, with a bit from the other side. So some bankers and some issuers, or potential issuers. So we've called it developments in financing and capital markets, which, as you rightly observed, could mean more or less anything. We've got a whole list of topics here that we've talked a little bit about in preparation. But of course, again, anybody who wants to join in and propose another topic, please go ahead and do so. So just checking where everybody is. To my left, we have Martin Blum, who is the head of Debt Strategy and Capital Markets Development at Raiffeisen. You're based in Vienna, aren't you, yes. Martin? Yeah. Zoltán Kurali leads little introduction, CEO of the AKK. Who we got on the end? Olaf Toelke is Managing Director and Head of Corporate Ratings at Scope Ratings, who are based in Berlin, although Olaf himself is in Frankfurt. To my right is Peter Töreki, who's the Head of Group Funding in the Treasury unit at MOL. A Fortune 500 company.
All right.
Well, aren't you?
If you say so, Chris.
Well, apparently you are. So he's terribly modest about MOL. Anna Grochowska has an enormously long title. You just need a card about this wide. She is Deputy Head, National Financial Systems, Directorate-General for Financial Stability, Financial Services and Capital Markets Union at the European Commission. And Mihály Geiszbühl is the head of Treasury at Erste Bank in Hungary. So, to start off, let's just have a... Following on from the discussion about liquidity and so forth, in the last discussion, I just want to have a look across what people think in terms of Hungarian issuers, bond market issuers, fixed income issuers, in terms of their access to global bond markets, particularly as that compares to their counterparties around this region. So, Mihály, why don't we start with you? How would you measure or gauge the level of access that Hungarian issuers and potential issuers have to global markets?
Thank you very much for being here and being invited. It's an honor. Back to your question, I think relatively, maybe there is some disadvantage, but I think it's not coming from the fact that these companies are Hungarian, but due to the relative size. I think global names like MOL or big Hungarian companies can easily have access to the international markets. When it comes to funding to attract, I think pricing is a different issue, but it's relatively easy. When it comes to big Hungarian companies, which on a European level, just being mid-caps or smaller, that's much more an issue due to the size, because they cannot reach the benchmark or some sub-benchmark size. So I think when it comes to and we talk about how the Hungarian companies can have access to the international market, I think the biggest disadvantage is the size of the companies. They need funding in a size of 50, 100 million euro typically. These are the so-called Hungarian companies, and it is something which normally should be done on the local market. This is too big for the local market, but too small for the international market. So if I have to highlight one major point why there is a limited access of Hungarian companies to the international market, I would say one primary reason for that is the size of the companies that come from the structure of the Hungarian economy. If I have to point just one.
And Olaf, I think you said that you rate 18 Hungarian corporates, but do you also have the sense of a kind of mid-sized trap, too big for local, not big enough for international? And when I asked György Eder on the previous panel, what other potential issuers might there be, he said, they look pretty hard from the point of view of an asset manager, and didn't really see any beyond, the handful that we all know about who could issue internationally. So you're rating them primarily on their domestic credit aspect, but give us your view.
Yep, that's absolutely true. I think the size issue is a very relevant one for international investors. I mean, if they want to move into a position, they don't want to have 50% of the whole issuance on one position. So here, clearly, we see our role, and I think 3/4 of the companies we rate are SMEs, small and middle-sized companies, partly family-owned businesses with 20 million sales, maybe even less than this in hard currency. I see our role more in preparing them, in making them also knowledgeable about what is required to talk to investors. It's also a communication issue. Sort of tell your story, prepare your credence or your prospects with investors. It's also communication, credit story, and enabling them to also grow. I mean, they can use the rating as a means to acquire companies, first maybe domestically as funding, and then maybe internationally as well. But you need to pave a track record based on performance, consistency, and sticking to your expectations, which is something which investors value very highly and which is not known by any company. So in a way, we also have this, I wouldn't say advisory, I shouldn't say this, but certainly educational role to take them by the hand, basically, and say, look, if you really want to play capital markets, and many companies, the first time they go into capital markets, you need to know certain things, how to behave in this new swimming pond, basically.
I mean, the global bond markets, or all bond markets, are obviously a force for discipline. If you're going to start borrowing money from international capital markets investors, you're going to have to submit to quite a lot of transparency and discipline that you maybe perhaps not.
Yeah, and you need to be aware of what is important and what not. I mean, sometimes we talk to management and we think, okay, maybe they shouldn't tell us this, or they should also focus on other things. I mean, concept of financial policy, for example, sometimes is not known at all to companies, which is more or less, what do I do to support the credit rating if things go wrong? Can I get rid of, or can I sort of not pay the dividend for 1 year, or can I help otherwise to keep the rating where it is and not get downgraded by 2 notches, maybe by selling non-core assets, something like that. So it's a credit story, financial policy commitment. Some people don't even know this. So here, moving into this, and the other complication was when I rate Unilever or Sanofi, there's 3 or 4 existing ratings. So I know roughly where the benchmark is. When you go into Hungary and other countries, there's no existing rating. So we as a rating agency, sitting outside, not speaking the language, not exactly knowing the culture, we have also something to lose. And so we need to come in and need to be very careful that we don't miss any potential risk. And here, therefore, it's a nascent or sort of an initial phase we are in. But we can help companies to really build up credibility and to qualify initially for domestic bond markets, and then secondly, maybe also for international bond markets. So it's a good chance for them to grow, because size, as you said, Mihály, is disadvantageous compared to other markets, but it's a good size really to develop on from this basis.
Zoltán, and obviously we all know that you have plenty of access to markets, but one of the functions, or one of the kind of collateral functions often of debt management offices like your own, is to kind of establish a presence internationally, establish a yield curve and so forth, to prepare the ground for companies to issue, banks or industrial corporations. Is that something that you consider in your plans? I mean, is there a kind of cohort of Hungarian issuers ready to go into the market that haven't, or is that just not, are they simply not there?
Yeah, so I think first a little bit of a history, sort of not necessarily a lesson, but like a little bit of a description of how this works. So clearly, we have a market economy since 1990, so that's not a very long time. And the banks in Hungary, either because they got privatized or because the local banks got really strong, really offered good financing solutions for corporates for long, which meant that there was no need for the corporates to go to the international markets. There was a very strong mortgage fund briefer market in Hungary up until obviously the financial crisis. And then beyond as well, but then, not really international issues because nobody was taking FX debt. With respect to the pricing reference you mentioned, yes, so we are the pricing reference for local corporates, and government guaranteed spreads and sort of sovereign, SOE spreads and then corporate spreads are rightly or wrongly derived, from the sovereign. Hence, we have to be really present on these markets. Obviously, we are now present in dollars, euros, Japanese yen, as well as RMB. So whoever wants to issue in these markets, which are basically the major markets for funding, apart from obviously the UK and Switzerland, they can find the reference point. We have a curve. And we also have green bonds as instruments, so that can also be a reference point from a green bond framework quality point of view, but also from a pricing point of view. And we also have green bonds in our domestic currency. So I think we take that role very seriously.
Martin, your large part of your role is what we would call DCM origination.
No, but nevertheless.
Yes?
More from the trading and client side, but nevertheless, similar area.
Okay. The bank, nonetheless.
Yes, it's a bank.
The bank does do that.
Yeah.
So, in terms of looking at new Hungarian credits, and of course you have comparators all across the region where you're active, are there notable pricing differentials across geographies? And insofar as there are, what is driving that? I mean, is it simply credit, or are there other factors at work?
Good question. I mean, I think obviously we've just discovered that it's the sovereign curve in the hard currency space, which is the dominant one, and it's easiest to compare across geographies. And in the dollar space, for sovereign Eurobonds in CE or in EM, if you plot spreads versus ratings, composite ratings, you don't get too much dispersion around the line of best fit. So 85% of the spread variation is explained by the composite rating, so what Olaf is doing or what the other agencies are doing. So that's the first point to highlight. Nevertheless, what we did see in the financial space when we had in the last year or two this growth of the MREL financial issuance in the region, that CE MREL issuers, so banks, did pay more than their Western European equivalents, but that is gradually, that's converging over time, particularly in the higher rated space. So the simple message is that credit quality in the hard currency space explains a lot of the variation in spreads. And then obviously in addition, lower liquidity, credit, smaller issues obviously have an illiquidity premium too. And then of course on top of that there's idiosyncratic factors, but it starts with credit quality.
Yeah. So the majority of it is just what you would expect from standard credit analysis across the piece. I don't know if I mean, does everybody in this room know what MREL means, or MREL? It's a reasonably esoteric bit of financial jargon. It's to do with the amount of loss-absorbing capital on a bank's balance sheet. Is that an accurate description? And obviously it's a Europe-wide regulation. And we're going to talk about it a little bit more, which is why I thought it was important just to bring. What does it actually stand for? Remind me.
I thought you were going to ask me this, and I was just wondering.
Minimum
requirement of eligible liabilities.
Minimum requirement for eligible liabilities.
And own funds.
What?
Own funds and eligible liabilities.
Right. Okay. This world is definitely full of alphabet soup, as I said earlier. Peter, let me turn to you. We just had a bit of a conversation about ratings, about pricing, and so on. You last accessed the international bond markets in 2021, is that correct?
2020.
2020, okay, 2020. And there are rumours that you might consider returning to international financing operations during the course of 2024. So obviously, as you've been planning that and considering that, you've been taking advice from your banks and perhaps from potential investor accounts and so on as to likely pricing and other considerations around returning to the market. So could you tell us what some of those are and how do you view a potential new issue or series of new issues by MOL shaping up in terms of currencies, maturities, when you might go, what might drive, what might be a go, not go kind of decision?
Sure. Well, I guess rumors can come from the fact that we made our program, so we have an EMTN program since...
You told people about it, yes.
And end of September. But that being said, that program was basically put in place for, well, I mean, in the morning as well, we heard a lot of times volatility, uncertainty, and so on, which we convert that to the capital markets terms. It basically means that if someone would be thinking about an issuance, then issuance windows are much shorter. So it's much less time to react. They can go away much quicker. So the kind of option value of a program, having a program, is now probably more. And that being said, basically it was established as an insurance in this sense. So if there is a need, we have the quicker access to markets.
The documentation was done, it was all there, you could press go reasonably...
Indeed.
Immediately.
Reasonably immediately, yes, I would say.
Yeah.
But with regards to the actual plans, I mean, that's basically like one of the cards in the pack, I would say. So it's not like that we're preparing for something immediately, and not at all. I mean, ultimately, our role is basically to secure that we have the proper amount of funding for the company's different purposes, capex and so on. So we are driven by that, essentially. We have to be ready to be able to move, but we're not kind of doing it just, you know, lard pour lard, that, okay, now we think that we should be going because we like the relative terms of the capital markets now. In general, about the markets, I'm not so sure I'm on the same side, actually, because I do see there kind of a displacement in the price, or in the, let's say, the perceived risk premium.
What Martin calls idiosyncrasies are a bit more significant.
Yes, indeed. So, like, I mean, in general, like, risk perception of the market, I kind of try to identify with the CDS, the credit default swaps, and essentially that level, if we look around in the region, obviously was distorted a lot when the war broke off. That's natural. But after that, the normalization was on different scale, for instance, in Poland, in case of Poland, than in case of the Hungarian. So we are still being, Hungary is still being a bit punished in this sense from the market
and let's be
perspective.
Pretty clear about it. You are positing a political motivation for this.
I'm not saying what's the reason. I'm just saying that
okay, well, what is the
didn't
reason
go back. You tell me.
Well, would anybody like to hazard a guess? Clearly, the whole question of although this applies equally, or has applied equally to Poland, which you also mentioned, the sort of degree of disquiet between the European Union and those two countries about various issues, which we're not really here to discuss, but we all know what they are, and they're in the background, and if anybody wants to unpack them, obviously we can. But so you do see there as being pricing discrepancies that are not credit-based. And notwithstanding the fact that you, as a multinational corporation, you operate in dozens of countries, right?
Indeed.
But if I understood correctly what you told me before, all of that activity is funded centrally.
Yes, we have a fairly centralized financing, indeed, with small exceptions for good reasons, but in general, yes. So when we talk about long-term financing, then essentially it's centralized, and we channel in the funds at once and then channel down towards the subsidiaries.
Which is the biggest operating unit outside Hungary?
The biggest one, I mean, I would guess it's INA in this sense. So
What?
Croatian subsidiary.
Croatia.
Probably.
Okay, so the Croatian subsidiary, were it to go to market itself, would still be very much a Hungarian company.
No, it wouldn't. No, I think. No, they are actually one of the exceptions where we allow and where we actively help to have external financing on their own as well. Obviously, a bit like in Slovakia, Slovnaft, so the national champions are always well perceived by the market, and they are the national champion in this field there.
Okay. Anna, let me turn to you, because and we can go a little bit into this MREL business. It's not Emerald, which, you know, kind of green bond it might be, but it's MREL, M-R-E-L. But also just sketch for us, if you would, I mean, you look, part of your role, your many roles, you look at financial system, financial sector stability across the systems, the countries, the markets you cover. So give us a little bit of a tour d'horizon, because obviously the whole conference, we're not talking only about Hungary, a lot about Hungary, but give us your view across the region of the relative health of financial systems. And then I'll stick with you and go a little deeper into this question of whether there are other EU-wide regulatory factors that are at play in terms of financing. So, but first of all, relative health of financial systems, and what do you observe in Hungary, Poland, whichever countries you look at most closely?
All right, thanks. Our assessment on banking systems across Europe. Well, we have representatives of some banks. They could tell us about their health. From our perspective, I mean, what is striking in the current cyclical moment is the high profitability, yes, that banks have been waiting for, helped by, obviously, monetary tightening. So this net interest income has been, very dynamically increasing, one can say booming. So that's certainly positive. It gives banks some space, also possibility to invest. At the same time, there are risks linked to these rising interest rates, and this is one of the issues we are closely looking at, especially credit risk, and in particular in banking systems where there is a high proportion of variable interest loans, be it for households or corporates. So the situation is quite different across Europe. Some systems are quite indeed exposed to this risk of changing interest rates. And here we have to look very carefully at the repayment capacity of borrowers, individual borrowers and companies. Because these higher interest rates, coupled with higher living costs, generally will affect them. So that's a bit the negative, let's say.
So are you predicting, in some sense, a degree of non-performing loans increasing, households defaulting? Is that where you're taking this?
I don't want to make predictions, and of course, from our perspective, it's the last thing we want to see. We are responsible, kind of, for financial stability, so we prefer that financial systems remain stable. But indeed, it is one of the key risks on our radar screen, so we cannot exclude them. Yeah, it will all depend how persistent is inflation. I mean, indeed, we have favorable trends now. Interest rates seem to have peaked, but okay, we have to look at economic developments and all the other factors. So that's one of the key risks we see across Europe. Next to this, of course, other issues, sustainability, it has already been there. It's there again also for Hungary, yes, quite energy, exposures to energy-intensive sectors. So maybe for Hungarian banks, this would be another element, among others, that we would look at.
And okay, thank you. And actually, I think we'll park a bit the regulatory emerald thing, and I'll come back to you on that in a second. Martin, can I just turn to you? The Raiffeisen obviously has a large presence in Hungary across the whole financial services sector. Your retail bank, commercial bank, and so on. So clearly you compete with other foreign banks and local banks, but there is a shift underway before our eyes in the Hungarian banking landscape with the formation of a new number two bank. I'd be interested if you would, just for your comments on how you see the system as a kind of competitive landscape with OTP very much the largest institution, this new institution coming in, the Hungarian Bank Holdings as number two in terms of size, and then of course yourselves and the other foreign banks that are active here. What's your kind of, I don't know, health check, or I don't know, just a tour d'horizon of the Hungarian banking scene?
I think the first point to highlight is the loan deposit ratio in the Hungarian banking sector is relatively low, and obviously radically different to how it was pre-financial crisis, more than 10 years ago. So if you look at it from a sort of loan deposit ratio perspective, the system is, it's got a lot of capacity potentially to grow on the one hand, and is not sort of is in quite a comfortable starting point. I think that's important. Secondly, and this is really to take a big sort of step back here away from the banking sector towards the economy, which obviously the banking sector is ultimately going to grow along with. I think if you look at Hungary from a regional perspective, Hungary is benefiting from nearshoring, friendshoring, has very high greenfield FDI commitments. That's not just important for the economy; it's also very important for the banking sector. The pie in general is growing, and therefore, if the pie is sliced up in slightly different ways, is perhaps less important than if the whole pie is growing. And I think Hungary's longer-term growth potential, particularly through these greenfield FDI projects, is a positive for the whole banking sector. The final point I would mention, speaking from the perspective of a bank with a regional presence, our RBI, is obviously we offer a slightly different product set to a national championship. We have a regional or a global product offering for our clients in Hungary in terms of not only corporate lending or household lending, but also in terms of hedging products. And in these volatile markets, if we have sort of competitive global or regional FX or interest rate hedging products, is important and sets us aside perhaps from a domestic specific player. So we have sort of a broad sort of access to global expertise and regional expertise, which I think is also important to highlight.
Okay. Mihály, if you wish, do you have any comment on the development of the competitive landscape in Hungary? And then I'm going to delve back down into this MREL topic that we've touched
yes,
on.
I think it's a natural process, and it will go further. So if you look at the size of the Hungarian economy and compared to the number of banks, there's still a long way to go, and it's in banking size is very important. So I think it's a sort of natural process. There was some help, now it's speed up after a long sleep. Something big happened, and I think it's going on like that. There will be more consolidation, and of course, Erste is ready to take the challenge.
And are there some non-bank financial institutions developing in the fintech arena, for example? Obviously there are, but are there any competitive
I don't think
ones?
it's so immediate in Hungary. No. It's not so immediate.
Okay, so to come back to this loss-absorbing capital requirement, banks, including yourselves, have of course issued MREL bonds specifically in order to create an instrument that qualifies as that loss-absorbing capital. But let's speak about that for a moment, if you would, but then from there, take us on to what these kind of regulatory restrictions, what impact they have on your ability to lend and finance the real economy.
I think it's sort of neutral at that point of view. MREL is a strange animal in a sense that basically, and bluntly speaking, banks are forced to issue very expensive instruments from funding instruments, get liquidity, which basically they do not need for business point of view. So I think it has when it comes to the Hungarian market, it has a sort of strange double twist that banks in one way drain the liquidity of investors, but at the time they backed up with extra liquidity. So I think it's very important to see that MREL is not something what banks really need for operational point of view, banking point of view. It's a regulatory liquidity from a business point of view. So now all the banks who were forced to issue MREL and attract more liquidity and financing capacity at the same time are forced to make use of it. So it's also stirred up the market. So it's a sort of shift of activity. It's like a bit of hot potato going around. What I mean by that banks are, it's limited due to the risk what the central bank is strictly watching, but still banks somehow involved buying in MREL bonds or others. So just the liquidities go around like in a strange game. So that's definitely have some impact on the market, on the behavior of individual participants. But overall, I think it's a sort of zero-sum game.
Okay. Anna, let me, from a regulator's point of view, I mean, you're always stuck, any kind of financial regulator is always stuck, ultimately, it's a political decision, right, which is then fed down. So ultimately, you've got this desire or pressure that states want to put on the banking sector to lend more for economic growth, general prosperity, employment, all of the positive stuff. At the same time, particularly since 2007-8, you're terrified of banks going bust. Banks go bust because they lend money to people that can't pay it back. It's very simple. So at the same time as wanting banks to push out loans to the economy, you want banks to de-risk. And those two things are potentially mutually contradictory. How do you square that one away?
So,
Easy question.
You're right. I mean, these are two important objectives. So, in this sense, you're right. Ensuring that banks effectively fulfill their function of financing the economy, but at the same time ensuring their stability, solvency, soundness. To us, it's very much complementary, actually, not at all conflicting. Maybe to nuance a bit the latter, so the stability really underlies the ability to service the economy. And this is what we try to kind of explain, to communicate, that the stability of the banking system, all these capital requirements, other requirements, they are there precisely to ensure the continuity of the banking system in servicing the economy. So we would prefer that it's not seen as a kind of cost, burden, but rather as a
Expensive
necessity,
was the word that Mihály
need.
used, and I saw you write it down as he said it. Unless you're writing down something else. I know. You might be writing a poem, for all I know, but it seemed to be the word expensive caught your attention.
I stick to my view.
No, we note down, views, of course. It's always interesting to hear the experiences and insights, so of course we note them down. It doesn't mean we would reconsider the policy. So I believe the policy makes sense. But I understand the point of view of banks.
Bank capital, bank financing is an intensely technical and multifaceted field of human endeavor. I mean, you from tier one and all the different levels of subordination, and each new level of subordination is somehow different from the last level of subordination, and the whole bank capital field is kind of moving target completely. Is that a fair comment?
Sorry, what was the moving target?
You're thinking of that poem again, aren't you? I would say that the whole field of bank capital, in terms of different levels of subordination and so forth, different levels of loss absorption, is intensely complex and constantly moving.
It is a moving target, but I think we achieved a lot in the area of ensuring banks' robustness. So, yeah, a lot of progress has been made. So I think a lot of work has been done.
Okay. Zoltán, it's not your topic, but you're a former banker. And you used to, were you a FIG banker?
No, I was an originator for structured financings.
Okay, so
risk management solutions.
Complex stuff.
Yeah.
Yeah. What do you think of what people have said? Just in terms of the ability of the banking sector in Hungary, let's restrict it to Hungary, the ability of the banking sector to, what is a bank in essence? A bank is a machine for recycling household savings into productive industrial use. Is that a fair
Yeah.
short definition. So insofar as that's what a bank is, how effective is the Hungarian system at doing that? How do you view the complexities of these different kinds of regulatory structure? Yeah, that's probably enough questions.
Look, I think regulation is a given. And the regulation is always a reaction function to a crisis. And it kind of evolves as we learn. So I don't think, we should be, we should be complaining about regulation. It is what it is. And the cost side of it, obviously there's a lot of fixed costs coming through because of regulatory compliance. And, obviously return requirements and profitability expectations of shareholders have to adjust accordingly. So I think the Hungarian banking system operates perfectly. Obviously it changes. Just one thing, obviously this region is going to need a lot of infrastructure investment into energy security, energy supply. Obviously the green transition of power generation is going to require a lot of, sort of energy infrastructure investment. In this country in particular, for example, project finance in the classical sense wasn't really needed because banks could provide the loans, Maybe these are project finance structures, but not your classical large, project finance structures. This will come, this will be something new. Obviously, capital markets, banks have been present, and they will continue to be present. Now, they have to be present, through the MREL requirements, but that's okay. So I think it's fine. I don't think, this actually has a negative impact on the other asset classes, i.e. corporate debt or the sovereign. This is a natural, sort of transition, and it has to be embraced. Change is good.
And I was very impressed this morning that the guy from the Austrian Central Bank quoted Lampedusa, that for things to... Fantastic novel, by the way. If you haven't read it, you gattopardo. You have got to read it. For things to change, for things to stay the same, they must change. Martin, switch to a slightly... comment by all means on this topic we've just been covering, but I'd like to move on to the question of, darting around our list of questions a bit, to the question of what sort of alternatives are there or might there be for SMEs across the region to straightforward bank lending?
I'm going to spend more time on the previous topic than the SME topic.
Well,
but
it's up to you.
I just, on the MREL topic, to pick up on what Mihály said on expensive, for every investor in the room and for every investor, around the world, expensive means obviously opportunity as well, that you're getting good quality financial credit at excessively wide spreads. And I think that's been a key thing that we found talking to investors in the last year or so, that the more you put this asset class, which is a rapidly growing, regulatory-driven asset class, onto the table, the more A, interest you get, and the B, that this expensive nature of funding relative to the parent bank in the multiple point of entry regime, it gradually comes down. So there is something which banks can actively do about this excessively expensive MREL from a regional perspective, and that's to obviously spread the word. And it is a new, big, relatively big asset class. So in CE, it could be 10 billion euros, next year in terms of outstanding. So I think that's an important message, that the expensive also means opportunity from an investor perspective. On the SME topic, which I'm desperately trying to...
You're a big bank. You're in most of the countries of the region. Yeah. So, you have commercial bank managers who sit there and, their local companies, they go and play golf with them and so on, and they, lend them some money or don't lend them some money. It's part of the business of the group, right? It
yes,
may not
absolutely.
be your personal business, but we've only got you to ask.
Exactly. No, so on the SME topic, I think one point is that the nature of SMEs have changed over time as well. You have now, in the service sector, IT sector, programming, it's a different SME to what it potentially was 10 years or 20 years ago. And secondly, I think on the SME topic, what you do see is that this is something which is often involved from a government perspective in terms of development plans, and development banks, and some of them have some sort of equity financing component within the SME, because one of the things with SME in particular is their thin and narrow equity base. So it's not just a question of lending the money, it can also be a question of growing equity, which is not just from retained earnings. And that's something which is more of an equity topic and can also be sort of a development program topic.
Mihály, I mean, have you got a thought on that? Because I mean, again, it's not your particular level area of banking, but obviously the bank does do this. And I know that I'm not sure. Is the stock exchange represented here? I know that Richard couldn't come because he's away, but anyway, the stock exchange, the Budapest Stock Exchange, I know has a particular program where it seeks to educate SME owners, partners, and shareholders into ways of accessing capital rather than just borrowing it from the bank. I mean, do you have some thoughts on that? I think it would just be interesting to know where that is.
There is the Nomad, this nominated advisor, there is some advising, and there is a special section called Extend. This is the, let's say, the entry point for the stock exchange. And there are quite a few companies there, but and at the same time, it's also an initiative by the stock exchange. They have this every year, and I think this year it was the 10th or 11th occasion. They selected 50 companies, which sort of prospect for and ready to go to the stock market. I think it's from an educational point of view, these are very important initiatives, but if you look at the result, it's relatively limited. If I am not mistaken, and it's a 10-year process, so quite a number of companies, and overall, not in the premium, but in the standard section, there is 2 companies out of this, let's say, quite big pool of the companies. So, and I can only repeat myself, maybe that's my mantra, that I think if you look at the size of the SMEs in Hungary, I think this is typically, we can have a look at it from different angles. This is ask for or cry for bank financing. So only large Hungarian companies, again, I think it's important to see that in the European level, these are mid-caps. They are ripe for the capital markets. And again, this after the privatization, that the structure of the economy where we are only a handful of such companies. There are lots of international companies. You shouldn't forget that, if I'm not mistaken, 30, 40% of the corporate financing is intercompany in Hungary. That's extremely high internationally. That also shows and reflects the structure of the Hungarian corporate sector. So I think right now, looking at the size of the economy, looking at the size of the companies, I think there is no better solution than bank financing. And I'm just hoping we will see real bank financing soon, because just one comment on that right now, only banks are really channels to let's say, transferring the money of the state, because roughly 50% of the new loans are subsidized loans. That comes from the interest rate environment. So I just hoping that the good old normal SME bank financing comes back, and I think this is what perfectly the best solution at this stage for the Hungarian SMEs.
Peter, obviously MOL is the antithesis of an SME. I'm going to get you to agree with something I say in a minute.
Fine.
But nonetheless, I mean, obviously you have an enormous number of companies in your supply chain. Some of them will be smaller. I mean, do you ever, as a group, and 2 things that I think perhaps you might do, maybe you do, maybe you don't, you'll tell us. One would be kind of supply chain financing. So companies that are supplying you with products or services that you require, you might assist in financing them. And the second thing is, do you have anything like a sort of, what people these days call it, the fintech panel will be full of this sort of jargon, a sandbox, or, do you finance a sort of technical group to do blue sky thinking and so forth in terms of, I don't know, greening the oil business? So there are 2 things that you might be financing, you might not be. You probably
Okay, well, starting with the first one, so supply chain finance. We did have, we don't have, we may have in the future. So that's kind of the story of it. With supply chain finance, I mean, there are several different things called supply chain finance, actually, but one particular arm was basically where in the zero interest environment, there were such kind of differences between the buyer and supplier in some cases, financing cost-wise, that it basically made sense to say, okay, the supplier says, instead of 30 days, you can pay to me 90 days if I can use your nice beneficial rates. And because of that big difference in the financing costs, it made sense to make that kind of a handshake deal and agree. Now, after the zero interest rate environment very much is behind us, so if we fast forward to today, currently, I mean, let's stick to euros, not forints. It would be a bit uglier probably, but let's stick to euros. Then you have to add 4% for both of the financing costs on the two sides. So basically, if there was a deal space that, okay, 0.5% and 2% spreads originally, that's a 1 to 4. You could agree in a 30 to 90 days, both sides still wins. Simply because we shifted up the interest rates. Now it's 1 to less than 1.5. So now you cannot add 90 days. And if you agreed earlier, you're making a loss actually as a supplier on that one. So that financially motivated supply chain finance agreements, kind of, that's a much narrower deal space now. On the other hand, why I said it may come actually, that there are some regulations essentially coming likely on supply chain due diligence requirements, supply chain due diligence directive. And as and when that comes, I mean, that basically will require buyers to vexate their suppliers with a bunch of questionnaires and so on. And one of the ways could be actually how they are motivated to still remain their reliable, stable, partner, is to say, okay, I'm not asking for, payment term extension. You can just participate in my supply chain finance program for helping me comply with these additional regulations. So that can be an extra push for that product in the future, I think.
Okay, good. Anna, part of your job is Capital Markets Union. I mean, obviously, the background to this clearly is that European companies, leaving aside the UK for the moment, say German companies, typically pretty much all their financing came from banks. Say 2/3 from banks, 1/3 from markets. Probably it's even more unbalanced than that. In the United States, it would be the inverse of that, even for relatively small companies. Capital Markets Union, obviously, part of its aim is to enable smaller companies to access market kind of financing, rather than bank financing. That's the background, right? That's part of it. So where is it going? I mean, the example I gave you when we were chatting before, that a Dutch pension fund might buy bonds, perhaps a private placement from a Spanish furniture manufacturer, that kind of thing, when is that going to start happening?
Yeah.
And what impact does it have on companies outside the Eurozone?
Yes. I mean, yes, CMU is a big topic, long-lasting project. Indeed, it's about, as we were also chatting, incremental, step-by-step progress, changes. So maybe I give a small update on the recent actions, also maybe referring to what has been discussed, SMEs, and what can have effects beyond the euro area. So indeed, it's a very multi-sided project. Actions are aiming various stages of development of a company, various fields. So very briefly, I don't want to bore you either and leave space for others. So first area, transparency, information landscape. So here we have European single access point. That's a recent achievement. Also European consolidated tape. You may remember discussions. Now it's there. So we hope to show up also in trading data and market activity. Then equity issuance, and in particular SME access to public markets. Listing Act, it's precisely aiming to ease some procedures for smaller companies. There is still a lot of work done about retail investor participation. That's another, let's say, side of the coin, yes, to make retail investors participate. It's not yet fully the case in Europe, as we know. So we have actions, recent actions in this field. Then a lot on market integration, and some themes have been mentioned earlier in panels. This withholding tax procedures. We have now new ideas, new actions to simplify, precisely accelerate these procedures. Also some difficult topics like corporate insolvency. It's still with us, not easy to tackle.
National regulations govern insolvency everywhere, right?
Right. We try to make them converge. So we have some now actions. Let's see what happens. So there is progress. There is also progress on national fields. So some countries do their own capital market strategies. We provide some technical assistance for that. There are also progresses at regional level. You may remember from the summer some achievement, a Baltic index. Yeah, so making one of the index providers treat the three Baltic countries markets as one market. That's quite an achievement, maybe an idea also to develop regional markets.
Admirable, obviously, and there are three wonderful countries, all of which I've visited with great fondness, but they are collectively smaller than a large city. So, I mean, Benelux, if you could say it was Benelux, that might be... Anyway, Olaf, are you... Capital Markets Union, is it a real thing? Are you a buyer of the story?
Yeah, it's difficult to judge from my point of view. Of course, we would welcome sort of unification and make the market more transparent and more accessible across the region. So, yeah, I think I'm not part of that political discussion. You know, what's the hindrance of it? But, certainly would be a good thing from my point of view. But on the other side, this diversification, I mean, funding diversification also for a small company cannot be bad. I mean, we've seen some companies who've been taken over by the banks, some family companies, because of covenant violations, which is for a family, which is the worst case which can happen. Some certain funding diversification, not only being dependent on the banking market, but also capital markets should be quite a good motive for small companies to follow.
We've got a red zero flashing there, but we've actually got a couple of minutes left, because that's obviously meant as a kind of goad rather than an actual guide. Zoltán, have you got a thought on the corporate financing universe in this country and how you think it might be improved?
Look, I think as long as the corporates get what they need from the current intermediation and there is no regulation forcing them to do something else, then the market is going to settle. I mean, supply and demand will have to meet. The central bank was making an effort to introduce a corporate bond program, which obviously flourished, you know, until the high inflation environment hit, and central banks stopped buying these bonds. And then nothing necessarily happened afterwards. So I think certainly there is room, but this room is only going to get filled if the demand is there. So I think there is a natural way things develop, and I think this is this is a relatively small market. So, you know, in that regard, you wouldn't see a Hungarian SME-sized company in Germany doing a bond, right? It's just the barriers of entries are too high. Capital Markets Union is a good thing because of the fact that it aims to, or could be a good thing, it aims to standardize the requirements. And I think that would help. And obviously, if it leads to a sort of a reduction of the barriers of entries, then maybe it helps. But I don't think we need to force things. So things happen naturally. And if things happen naturally, that's great. Forcing things will always result in some sort of a disequilibrium. And so I'm getting very philosophical, right?
No, that's absolutely right.
You didn't ask me about liquidity of the government bond market and all the rest of it.
Well, we talked a bit about that before, but you're right, forcing things, which is why roundabouts are better than traffic lights.
Yeah, 100%.
Traffic lights are communist.
Because they are red, yeah.
Right, well, on that final note, thank you all very much. We obviously could have talked a great deal more about many aspects of this all-embracing topic. I'm guessing that on our final panel, which is going to be about technology and fintech, there'll be a bit of discussion about venture capital and seed capital and those kinds of things, which is obviously even further down the sort of corporate financing ladder than we've been able to delve. But before that, we're going to talk about financing the green transition.